Today I'm going to talk to you about the basic options available when a pension is involved in a divorce settlement. When a married couple divorces or a civil partnership is dissolved, it's often the case that one or both parties will have assets in the form of a pension. When the divorce settlement is instructed, the value of that pension may form part of the assets to be divided. There are three main options for taking pensions into account in divorce. The first and original method of dealing with a pension is offsetting. This is where the value of the pension is calculated as a lump sum, which is an asset which then needs to be offset against another asset. So, for example, the ex-spouse who retains their pension in full will be entitled maybe to a lesser proportion of the other assets to reflect that they're retaining their pension. Or perhaps the ex-spouse will be entitled to a source of income to offset their loss of future pension income. Essentially, the equivalent lump sum value for the pension is used to determine how much extra assets the other party should get to ensure that those assets are split according to the divorce settlement. This has a few advantages. Firstly, it's simple. The pension is left in the member's hands. It's also not affected by death or remarriage. However, care will need to be taken with regards to the tax position of any income calculated to reflect the values after tax. Also, if a death in service payment was attached to a works pension, the nomination could be questioned on the member's death, particularly if the member had remarried and not changed the nomination. Next, earmarking. This method came in next and is sometimes called an attachment order. This essentially earmarks a proportion of the member's pension for their ex-spouse. This could be in the form of tax-free cash or income or perhaps both. It's always expressed as a percentage of the pension, and care needs to be taken to ensure that the percentage is based on the spouse's entitlement at the time of the divorce and doesn't include any subsequent contributions that are yet to be made by the member. If it's a defined benefit pension, predictions about future pay rises have to be made, which could be tricky. This option also isn't necessarily tax efficient. When the member retires, they pay tax on all of the pension income, even though some of it is going to go to their ex. Therefore, it's possible to have a situation where a member pays high rate tax on the pension income, whilst their ex-spouse is a non-taxpayer who can't use their own allowances. It's also worth noting that the ex-spouse has no control over the pension, not how it's invested, whether it's transferred, and crucially, not over when the member starts to take their benefits. Therefore, the ex-spouse's retirement income remains in the hands of the member. There's certainly no clean break. Finally, pension sharing. This does what it says on the tin. The value of the pension is shared between the member and the ex-spouse. This doesn't necessarily have to be 50-50 and can be based on whatever percentage the settlement requires. The split happens right away, so there is a clean break between the parties. This means that each party will need to deal with their own pension pot once the split's happened. It should be noted that pension sharing generally doesn't apply to the state pension, with the exception of one or two historic elements of the state pension. This method does provide a clean break, whereby subsequent death or remarriage will have no financial impact on the other party.